I want to introduce Doug Orton. Doug Orton is a CRPC, works at and as a vice president of business development since 1993, and he works with advisors and clients to educate them on things that they should do and, more importantly, things that we shouldn't do. So, Doug, thank you so much for taking time out of your busy day to join us at ICG Next, and welcome. And thank you for coming on board today.
What I want to talk about are some of the mistakes that people tend to make on their IRAs, but please don't take today as a bad news session. Sometimes when we start talking about mistakes, people get a little nervous. The good news is most of these mistakes are much easier to prevent than they are to fix. So as I'm going through the mistakes, if you think one might apply to you, in many cases, taking 5 or 10 minutes now to review your individual circumstances with the team is enough to avoid the mistake, or at least drastically lessen the chance that it happens. The second thing that I want to say is some of the things I'm going to be sharing are rules of thumb, and rules of thumb work for the majority of people, but they don't work for everybody. So don't take anything I say today as individualized advice. I would view it more as a diagnostic, the starting point of looking at whether this is an issue for you. But the first thing I want to talk about is pretty much a universal to everybody, which is don't leave your beneficiary forms blank and don't let them get out of date. IRAs passed by beneficiary, that's a great news because it avoids probate. There's a lot of things that are a benefit from passing through beneficiary designations. The downside is beneficiary designations tend to get out of date relatively easily. In general, what you want to do is name both primary and contingent beneficiaries. Using my accounts as an example, my wife Amber is my primary beneficiary on all our accounts, and our children are the contingent beneficiaries on all the accounts. That makes it very flexible, so that if when I die, Amber's predeceased me, she's died first, it'll automatically go to the kids, no fuss. Or if I pass and she's still alive, but for maybe tax reasons she doesn't want to accept the account, she can disclaim it. It goes to the next people in line. That would be the kids. Very flexible designation. That idea of disclaiming is exactly what you would do on an outdated beneficiary form, because a lot of times what will happen is we name somebody as our beneficiary and then later our life changes. We have children, we have more children, we get married, we get divorced. And so sometimes by the time we pass, the person who's listed as the beneficiary probably shouldn't be. And this is one of those that's easier to prevent than it is to fix, because the mechanics of it are simple. The outdated beneficiary disclaims it, it goes to the next person in line, very easy. The issue, one of the most common outdated beneficiaries I've run into is an ex-spouse. And I have never seen a case where an ex-spouse disclaims an account so that the new spouse can get it. Maybe it's happened, but I certainly haven't seen it. So good idea to review your beneficiary forms anytime your life changes significantly or once every couple of years, just to make sure they're in line. Second thing I want to talk about is related. When you inherit a retirement account, this can create a tax issue, because just like when I take money out of my 401k or my IRA, that creates taxable income for me, same thing's going to happen when my kids inherit my account. The difference is a lot of inheritors don't understand the implications. And so what we see a lot of times is somebody inherits a $300,000, $400,000, $500,000 IRA and liquidates it all immediately. Now, as you can imagine, if I decide to liquidate a $500,000 IRA, that adds $500,000 to my taxable income this year. It doesn't matter what tax bracket I started out in, I'm now in the maximum tax bracket. And that can cause a lot more taxes than are necessary, because most human beneficiaries are going to have at least a 10-year period to liquidate this account. There's some rules that you want to take into account, but spreading the money out or the taxes out over a 10-year period is usually going to be much more tax efficient than taking it out all at once. So if you're inheriting an account, it's easy. Just talk to your financial advisory team before you make any decisions. As we pass our accounts to our heirs or our children, that's a little bit more complicated. We just need to let them know you need to talk to my advisors before you start taking any distributions. And we'll talk about how important that is when we start talking about direct transfers. All we need to know for now, get advice before you start taking distributions. Spouses are going to have options that other inheritors don't have. It is a very flexible in how spouses inherit accounts, and it's actually going to get a little more complicated next year. Secure 2 added a third option to what spouses can do, and I'll talk about that, but let's go through the 2 options that spouses have now. The first is you can roll your deceased spouse's IRA into your own account, and that is generally what most people do under current rules when they inherit at a reasonable age. Let's say I die at 87 years old, Amber's 85, her rolling my account into hers, great option. But if I died today, that is not a great option. If I die today, Amber rolls my IRA into hers, she's under 59 and a half. So any money she takes out of her retirement accounts is generally going to have an extra 10% penalty tax attached to it. So what she'd probably want to do in that circumstance is leave it as an inherited account. So it would be Doug Orton's IRA deceased for the benefit of Amber Orton. She controls the account, she picks the investments, everything just like it's hers. The difference is any money she takes out, coded as a death claim. Death claims are never subject to the 10% early distribution penalty, and money she takes out of my Roths would actually be tax-free. So that's the option that most people use if they inherit under the age of 59 and a half. And to make it even better, her ability to treat my IRA as hers doesn't expire. So she could just wait 9 years until she is 59 and a half and then roll my account into hers. And so under current rules, it's pretty easy to decide which option works for you. Next year, there is a third relatively confusing option. So Secure 2 lets spouses treat themselves as if they were the deceased spouse and the deceased spouse was still alive for RMD purposes. And I know that sounds confusing because it is. Where you might want to use this is if the younger spouse dies first, this becomes a good option. So let's go back to the example where I'm 87, Amber's 85, and Amber dies first. If I decided to roll her account into mine, that would increase the amount that I have to take out each year because of my required distribution. We'll talk about those in mistake 9, might make a little bit more sense. But if she dies first, I don't want to roll her account into mine because it ups the age. I'll probably want to use this new option. The takeaway from this, if you think about those 3 options, none of the 3 are a clear winner for everybody, but for each individual beneficiary, one of the 3 is usually better than the other 2. So when your spouse passes away, get advice before you make any decisions about what to do with their retirement accounts because it can have a significant impact on the taxes that you need to pay. Let's move on to mistake number 4, not using a direct transfer. There's 2 ways to move money around between retirement accounts. You can go direct and you can go indirect. Direct is better in almost all circumstances. So if I wanted to move from one IRA to another, I can go direct, which means IRA 1 pays IRA 2 directly. Everything's smooth, clean, very difficult to end up with an unnecessary tax liability. My second option is to go indirect. I have my IRA pay me, and then I put the money into another IRA. There's a couple of big downsides to that. One, there's a 60-day deadline. That seems like a lot of time, but for some reason, I've seen a lot of rollovers take 62 days. That makes it a taxable distribution. Problem number two, I can only do that once in any 12-month period. So if I've already done an indirect rollover and then I take another distribution, it's a permanent taxable distribution. Problem number three, I have the money in my account and I am going to be tempted as I drive by the boat show to make a terrible decision about it. So for me, it would really be the RV show, but either way, better to go direct. Similar problems happen when I move money from a 401k or other employer plan into an IRA. If I go direct, clean, easy, no deadline. If I go indirect, I have that same 60-day window. The other problem is I have mandatory withholding of 20%. So if I wanted to move $1 million from my 401k to my IRA and I go indirect, I only get a check for $800,000. I throw that into my IRA. Where does the other $200,000 come from? If I go direct, I avoid that problem. The last problem with indirect rollovers, and this is probably the biggest one, non-spouse beneficiaries never have the ability to do an indirect rollover. So let's say my kids don't understand how taxes work. They inherit my IRA, and so they liquidate it immediately. And then they realize that was a mistake. Non-spouse beneficiaries can't do an indirect rollover, so they can't put the money back. It's just a taxable distribution that they're stuck with. So in my opener, when I said many of these mistakes are easier to prevent than they are to fix, some of them are impossible to fix once you've made the mistake. But if you know about the rules, it's a very easy one to avoid because non-spouse beneficiaries can do direct rollovers. They just can't accept receipt of the money. So let's move on to mistake number 5, net unrealized appreciation. If you have your own employer stock inside your 401k, there is a very special tax treatment that you can use on that stock called net unrealized appreciation. And it would allow you to pay long-term capital gains taxes instead of ordinary income taxes on some of the distribution. And cap gains rates are just lower than ordinary rates, so this can be a substantial benefit. However, there are very specific rules that you need to follow to take advantage of it. So if you have your own employer's stock inside your 401k, there are 2 questions that I think you want answered by your financial advisor and potentially your tax advisor. One, what's NUA and is it of benefit to me? But the second question might be more important. Do I own an appropriate amount of my employer's stock in my 401k? And before you ask in the Q&A, I can't give you an answer to that question because I don't know enough about your individual circumstances to say what is or isn't appropriate. And don't get me wrong, I'm not saying that you own too much. Might be perfectly appropriate, the amount of employer stock that you own in your plan. But I can tell you that there is a cognitive bias called familiarity bias that will probably make us underestimate the risk of buying our own employer stock. Familiarity bias is just that we underestimate the risk of things we're very familiar with, and we overestimate the risk of things we're unfamiliar with. Great example of this is many people are nervous to fly, but not nervous to drive. Where statistically, covering the same distance, flying in a commercial airline, way safer than driving. The reason we think it's riskier is we're unfamiliar with it. The exact same thing happens when we buy our own employer's stock. And the reason I stress that one is really a personal situation. My father worked for a tech company running up to the internet bubble bursting in 2000. And because he was very familiar with the tech industry and his employer, much of his 401k was in his own employer's stock. When the tech bubble burst, he lost a lot of value in his 401k and he got laid off at the same time. It extended his work by a good 6 years in terms of his retirement. So again, not saying that it's appropriate or inappropriate, but not knowing the risk you're taking, that's a question that you do want to address. So let's move on to mistake number 6, not taking advantage of Roths. Roth IRAs or Roth 401ks. And soon, because of Secure 2, we will also have the ability to invest in Roth inside simple IRAs and SEP IRAs. They're not quite ready yet, but they are authorized by the law. So soon, you'll have a lot of different ways to access Roth. If you're unfamiliar with Roth, it's essentially the flip side of a traditional retirement account. When I put money into my traditional 401k, I get a tax benefit up front, then it grows tax deferred, but when I take it out, it's ordinary income, which is not great. The Roth is the exact opposite. There is no tax benefit up front, then it grows tax deferred, but if I take it out in retirement in the right way, it's tax free. And so whether one or the other is better really depends on your individual circumstances. But one huge advantage of the Roth is it is a very good tax diversifier, because one of the risks we want to think about as we're planning our retirement is tax risk. And in particular, for married couples, we want to start thinking about the survivor's tax trap. If we go back to the example of I die, I'm 87 years old, Amber's 85, here's what's going to happen. Her income is going to be a little bit lower as a single person than when we were married, primarily because one of the Social Security benefits is going to go away. However, her federal tax liability might actually be higher because filing a single return might increase her federal tax rate. Plus, your Social Security, what percentage of it is taxed, is based on your income and filing status, and your Medicare Part B premiums are based on your income and filing status. So that for a lot of people, their Medicare premiums will jump after their spouse passes away, and their federal income tax liability can jump. That is what we call the survivor's tax trap. And what makes part of that really difficult to plan for, particularly around the Medicare premiums, is that when they figure out your income for Medicare purposes, some types of tax-free income are added back in to the calculation. Roths are not. So it's not just that Roths are tax-free, they're not included in the calculation of how much your Social Security is taxed and what your Medicare premiums are going to be. So it can be a very strong diversifier from a tax standpoint. Let's move on to mistake number 7, not maximizing your IRA contribution. It's going to be a little awkward because I'm disagreeing with my own slide, and I wrote this slide. But not everybody should maximize their IRA. Not everybody should maximize their 401k. Some people need to save more than the maximum of the IRA or the 401k. It all comes down to 3 questions. When do I want to retire? How much income do I need? What steps do I need now to make those 2 things match? If you haven't had those questions answered for you, it is very unlikely that you're saving exactly the right amount. If we don't have a goal, very difficult to hit the target. Mistake number 8, spousal contributions. You have to have earned income to make IRA contributions, but it does not have to be your earned income if you're married. Your spouse's earned income also counts. So if you happen to be outside the paid workforce right now, but your spouse is, you can still make IRA contributions. Just because you're outside the paid workforce doesn't mean you shouldn't have a retirement income plan. You should, and IRAs can be an important part of that retirement income plan. So let's move on to mistake number 9, required minimum distributions. This might not be the most exciting topic on the list, but it is probably one of the most important. Once you reach the age of 73, and that number might look a little weird to some of you because last year it was 72, this changed because of Secure 2. It is now 73. We will eventually get all the way up to age 75 as the required minimum distribution starting age, but it's currently 73. Once you're 73, you have to start taking money out of your retirement accounts. And if you don't take out enough, there is a 25% penalty on the amount that you were supposed to take out, but didn't. Though it can be reduced to 10% in some circumstances. Unfortunately, I can't tell you exactly when it would be reduced to 10%. This is another change from Secure 2, which just passed in December of last year, and we haven't gotten clarification from the IRS when it's going to be 10%, when it's going to be 25%. But either way, those are still both substantial penalties. So there's a couple of things we want to keep in mind about required distributions. One, just know that you have to start when you turn 73. But two, we need to talk about the aggregation rules around retirement accounts because IRAs are actually relatively easy. If I've got 3 IRAs and my total RMD from IRAs is $10,000, it does not matter which account or which combination of accounts I take those withdrawals from because I can aggregate my IRA RMDs together. However, plans like 401ks do not work like that at all. If I've got 3 old 401ks, and let's say each one of them has exactly a $5,000 RMD requirement, and I think they work like IRAs, so I take 15,000 out of one of those 401ks. That one, yep, satisfied the RMD requirement, but the other 2, I took out 0. That means it's a $5,000 failed RMD from both. The total is 10,000. That means I'm going to face either a $2,500 or $1,000 tax penalty, depending on whether I get the reduction or not. And if that sounds a little confusing, it is. One thing to consider as you approach age 73, if you've got a lot of accounts scattered around and there's no compelling reason to have these old retirement accounts, maybe consolidate it down as much as you can. It's what I did with my parents as they approached RMD age. We got it down to 1 IRA for my mom, 1 IRA for my dad, set it up on automatic distributions, and we never had to worry about RMD penalties or them taking their RMDs. It's just a little bit easier way to do it. Coming into the final stretch here with mistake number 10, not considering qualified charitable distributions, abbreviated as QCDs. QCDs are one of my favorite parts of the code because this can save us significant taxes for the right person. So what a qualified charitable distribution is once I'm age 70 and a half, I can make charitable contributions directly from my IRA. So let's say I wanted to give $10,000 to the American Cancer Society. I could have my IRA pay the American Cancer Society directly, and it does not count as taxable income to me, but it still counts towards my RMD requirement if I'm of RMD age. And that might not sound like a big deal because you might think, well, I could just take the 10,000 out and then donate the 10,000 to the charity. I get to deduct it, and it's the same thing. It's the same thing for some taxpayers, but not for all taxpayers because not everybody gets to a full benefit from a deduction, but everybody gets the full benefit of an exclusion. And particularly after the tax changes in 2017, The majority of taxpayers get more benefit out of a qualified charitable distribution than making a donation. You can only do this up to $100,000 per year, but for most of us, that's going to cover our RMD requirement and probably our charitable contributions for the year. Last mistake, sometimes you need a little bit extra, so this one goes to 11. We're going to talk about paying unnecessary penalties on early distributions. I mentioned earlier, if you're under 59 and a half and you take money out of a retirement account, there can be a 10% penalty. However, there are a lot of exceptions to this penalty. We are up to now, I believe, either 16 or 17 exceptions. I am not going to go through all 17. I'm going to go through one, because I think the point that we need to understand is different accounts have different exceptions to the penalty. And if you get advice before you take money out, in many cases, there are perfectly legal, perfectly legitimate ways to avoid the 10% extra penalty tax. And the example I want to use is separation of service. If I leave my employer after January 1st of the year I turn 55, that employer plan is now penalty free, but only that employer plan. So let's say I'm 56 years old and I get laid off from MFS. The MFS 401k is now penalty free without any limitation. I can take a little bit out, I can take all of it out, I can take some out this year, some out next year. Doesn't matter. That plan is penalty free. But let's say I rolled that plan into my IRA. That no longer applies because I didn't separate from service from my IRA. That's not a penalty exception that applies there. I now just permanently eliminated that favorable tax treatment. So if you find yourself in that scenario, you're under 59 and a half, you need to take some money out of a retirement account for whatever reason, get advice before you do it, and there may be a relatively easy way to avoid the penalty. So with that, I want to thank you for your time, and I'm going to close with the two things that I opened with. One, these mistakes are easier to prevent than they are to fix. So if there was one that you thought, oh, that might apply to me, you want to take a look at it. And the second thing is, please don't take anything I said as individualized advice. This was more of a diagnostic call. I shared some rules of thumb with you that may or may not apply. If you think one of these mistakes might apply to you, getting advice about your individual circumstances is the right next step. So with that, I want to thank you for your time. I'll turn it back over to Craig.
Thanks, Doug. It was really informative. I really appreciate you being as detailed and specific, especially with your examples.